Hey, what's up you guys? Jason Wheeler here, and I'm making a video for you today because I want to talk to you today about the fastest way to pay off your mortgage debt, okay? And real quick, just a couple things about mortgages. I've been in this business since 2003 here in Northern California, and mortgages actually make me sick. If you actually look at the literal translation of mortgage, it means death pledge. Mortgage is death pledge in Latin. And they're actually specifically designed to keep you, the consumer, in debt forever. I mean, that's why everyone's always telling you this 30-year fixed mortgage. And everywhere you go, all the big banks are painting a picture that the 30-year fixed mortgage is the safest, best route for any kind of home loan financing. And 9 out of 10 people are going to agree. They're just going to tell you that, yeah, they want their 30-year fixed, and that's it. The fact is in the first 5 to 10 years of your 30-year fixed mortgage, even if you have a really low rate, you are paying almost all of that money that you're paying in mortgage payments is going directly to the bank. If you think the banks are out to get you, you're absolutely right. They want to squeeze as much money out of you as they possibly can. And within the first 5 to 10 years of your 30-year fixed mortgage, you're paying almost 100% of that mortgage payment most of it's going towards mortgage interest directly to the bank. Now, you might be also kind of surprised to find out that if you compare a 30-year mortgage at 4% and a 15-year mortgage at 7%, which one do you think you're going to pay less interest on over the life of the loan? Well, if you said the 30-year at 4, you're wrong. The 15-year at 7 is going to be a lot less interest. Now, your mortgage payment is going to be higher. But anyways, what I want to talk about today is the fastest, best way to pay off your mortgage fast. And I'm talking about, if you look at this, if you look at how this math is done, you could pay off your mortgage in as fast as 5 to 7 years. And instead of a 30-year fixed, you could be debt-free from your mortgage in close to 5 years. So if you could imagine having no mortgage in the next 5 years, what I want to do is dive into this case study that I'm going to show you real quick, okay? So we're going to do the math, we're going to do some numbers, and then we're going to come back and talk about it real quick, okay? So let's go ahead and dive in exactly how this works. All right, everybody, so let's jump in here and let's just look at a case study real quick. What I want to do here is look at a really basic case study. What we're going to do is we're going to compare a traditional 30-year fixed mortgage to this mortgage acceleration loan payoff program that pays off your mortgage fast and will also save you the most dollar amount in the form of interest, depending on your scenario. Every scenario is different, but I'm going to run you through a really basic one, okay? So we're going to look at a estimated home value of $600,000, and we're going to say that the 30-year fix we're comparing that against is an 80% loan to value, or 80% of the home's value, $480,000 at 4%. 4% is a pretty fair rate for a 30-year fixed based on where we are on the market. And as far as the principal and interest payment on that 30-year fix, it looks like $2,292 per month. Okay, so that's where I got my numbers from. I'm using $600,000. That's a median price for here in the Northern California Bay Area. So that's where I'm getting my numbers from here. So here's our new loan that we're going to compare this against. $480,000. Total monthly payment is $2,292 a month. Okay? So here in my market, let's say that borrower number 1 has a decent job and is making, let's say he's making $8,000 per month. Okay? And that's gross monthly income. Let's say his partner, so that's roughly $96,000 a year. That's not unheard of. Let's say his partner is making $6,000 a month. Okay? And that is $72,000 a year. Okay, so between the two of them, they have a dual income of $168,000 per year, gross yearly income. That is a really good middle-of-the-road income for my market. Now, again, the main requirement for this program to be for you is you have to make more money than what you're spending. So that's the main requirement. If you're in dire straits, if you're having trouble managing your money, this is absolutely not for you. But if you do have extra money, or if you are making more than you're spending, this is definitely something worth looking at, okay? So let's go on to the next step here. Let's look at total monthly expenses. Okay, so let's say between the two of them, they're making $14,000 per month. The mortgage that we're comparing it against is 30-year fixed at 4% would be $2,292 a month. And the rest is right here, okay? So they, after their mortgage, they have $11,000 left over. Let's say all of their expenses, after all their expenses, I'm talking about groceries, insurance, taxes, fun, recreation, everything that they do, let's say that they have 20% left over at the end of the month. So that gives them, they have roughly $8,900 worth of expenses, which I think is pretty outlandish. But let's just look at this conservative example here. So they have $2,800 a month left over after all expenses. And let's just see how easy it would be to pay off this mortgage with this method here, with those numbers. So with those numbers, with only 20% income left over, they're going to pay off the same mortgage that I'm comparing this to after only 10.4 years, and they're going to save $182,000 worth of interest over the life of this loan. That's compared to a 30-year fixed, where the total payments that they make on a $480,000 loan is actually $800,024, and you can see the savings is just staggering. So let's look at one more scenario here, and one that I think is just a little bit more realistic. So let's keep the deposits the same. This family is, again, they're still making $168,000 per year. Okay, let's say that instead of only having $2,800 left over, let's say that this family is really good at budgeting. Okay, let's say they have 40% of their income left over, which means that after mortgage, tax, insurance, they have about $6,100 worth of expenses, and at the end of the month, they have $5,600 left over. So what we're going to do is check and see how long, all other things being the same, how this will change things for this scenario. So now they're paying off their mortgage in just about 6 years here, and they're saving $258,000. Okay. Now this scenario is not going to work for everybody, like I said. But what I want to do is I want to give you access to this calculator. Okay. So if this looks interesting to you at all, I want to give you access to this calculator so you can run your own scenario, and so you can take a close look, and then you can decide for yourself if this is something that you want to get deeper into. Also, when you click through the other side, I'm going to give you a free video series that's going to explain to you step by step exactly how this loan program works, so that you'll have no questions when you get into this. Okay, so now that we've looked at this case study of exactly, how the math works in regards to paying off your home accelerated and paying off your mortgage fast, what I want to do is just talk about a couple of different. So you're probably thinking that, hey, this is an untraditional program. Is this some new scammy thing? Absolutely not. This is a program that has been around for years and years and years. Okay, this is not magic. It's just math. Now the math might not be exactly simple, but it is just math. It's not magic. Okay, this is not a new program. This is a program that many people already utilize when it comes to home ownership, but most people are utilizing it in the wrong way. Okay, so what I want to do is, if this is something that looks interesting to you at all, okay, now this program is not for everybody, because 9 out of 10 people, they really just want to stay in their comfort zone no matter what, and they're going to stick with their 30-year fixed mortgage no matter what I say, or no matter what the math says. They're going to stick with their 30-year fixed mortgage, because most people would rather pay more money than do something that's a little bit uncomfortable. And what I wanted to do is, on the other side of this page, when you click through, I'm going to give you a video series. I'm going to show you exactly how the math plays out, exactly how this program works, and exactly how you can go ahead and utilize this. And depending on your unique situation, you may be able to pay your mortgage off within the next 5 to 7 years, maybe even faster. Now, you might do the math, and this program might not be for you at all. Okay, this program is not for everybody, but this is definitely something worth taking a look at. Okay, so if you really want to be debt-free and mortgage-free in the next 5 to 7 years, I want you to click through below and go ahead and watch the video series, the video tutorials, where we're going to show you exactly how this program works. And if this is something that you want to get involved in, or learn more about, or see if you qualify for it, I will absolutely answer all your questions personally once you go through the crash course on the other side of this page. Thanks a lot, you guys. Make it a great day.